Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 172, 1st of February 2022. We had the budget today and it was more or less as we expected, a non-event. The finance minister did not really rock the boat on any front in terms of the markets, and the market, although was volatile during the day, however, it maintained and retained the gains that it made early in the day. Today's topic is about returns versus time. How we tend to, give a lot of emphasis on the returns from any instrument, any strategy, but we don't give emphasis to the time frame in which we can get those returns, or how the compounding can actually work in our favor even with lower returns. So we will take a look at some of those calculations today. So in terms of market performance, amazing market performance today from the metals pack, from pharma stocks, from commodity stocks, from FMCG. Only the autos, which were expecting some sort of budget SOP, did not get any. And PSU banks also, there was expectation that some PSU SOP would be announced today. That also did not come through. The divestment targets were also quite soft, I would say, and a lot of public sector enterprises were running up in some expectation of some divestment announcements. So a kind of a mixed bag, but really strong rally in real estate, IT, pharma, commodities, metal stocks. And it seems that the leg up has started again, and today's numbers of FII buying or selling will further bolster that thought. In terms of broader indices, all were up between 1 to 1.5%. CNX 500 also up 1.3%. Mid and small cap also up 1 and 1.3%. In terms of weekend investing small cases, almost all strategies were up between about 1% to 2.5%. So pretty much in line with the broader markets, some doing better than the indices underneath. So we've kind of erased all losses virtually within the last week, but over the last month we still have losses in CNX 200, ATH, ATH2, NNF10 and EverGreen. So if this is a new leg up and if we are going up to the previous highs and retesting those again, we should see very good numbers increasing in terms of strategy performance from here on. So yesterday on Twitter there was hectic discussion about compounding following this tweet, where I said that can you make 0.1% in the markets per day? And this was specifically, sort of tweeted to bring about the concept of compounding. And a lot of people were, of course, very pessimistic about that this cannot happen and this is a useless tweet. But I myself got a lot of motivation and encouragement from this tweet. Just imagine that you are investing 1 lakh rupees, and if you are able to do 0.1% in every market day, on average, I'm not saying 100% success rate, on average, if you are able to make 10 basis points, your capital goes from 1 lakh to 13.5 lakhs. That itself is a enormous sort of revelation from a perspective of the linear thinking that usually our brain gets into. So 1 lakh becoming 13.56 lakhs by 0.1% average gain per day is just mind-blowing to me. So that's what we will dwell upon more in today's daily bite. So this is essentially the heart of the compounding magic, where principal times 1 plus rate of return to the power of time is what basically makes up what will be the uh, the value or the final value at the end of it, or the amount. So a lot of times we are constantly running about, which strategy, what trade will give me the best rate of return. But we do not give enough emphasis or importance to the fact that for how long can we keep getting this rate of return. So if once in a while some strategy gives you a phenomenal return and then it goes to sleep for the next 2 years, then overall it may not be such a great compounder. But there may be other strategies which may give you a lower rate of return, but you have more surety or runway of that return keep on generating. Like for instance, let's take the example of option sellers in the market. Now there are strategies out there where people are capturing theta decay or some other part of some delta within the option Greeks, and they are doing it on a daily basis. So yes, some days are up, some days are bad, some days are good, but if you are doing 0.1% also on an average, you can see where your capital is going over the period of time. So even with very low returns, your trading can really take you from one place to a totally different place within a year, and within 5 years you may be at yes, of course every strategy will not scale up and this formula may not keep scaling, but still it is magical enough to give you that confidence, that motivation to try. And I'm not saying this is just on a daily basis. I mean, if you see this on an investment basis also, like we do momentum investing on weekly, monthly basis, even on a month-on-month basis, if your average returns are more consistent over a period of 5 years, 10 years, you will see the compounding effect there. So the returns are extremely overrated, I think. I mean, people keep running after strategies which will give 100%, 200% and 50% return. Even 15% return strategies will do very, very well, provided over a period of time they can more or less do it consistently. A 50% return in a strategy followed by a 50% drawdown in the next year, followed by 2 years of 50% return, actually doesn't get you anywhere. So what we need to do is to have more emphasis on the longevity or the runway of continuous or consistent returns than the return itself to a large extent. So small example, let's say start with a lump sum of 10 lakhs over 5 years. You do 50% returns, CAGR, which is, crazy CAGR. 10 lakhs goes to 75 lakhs. Whereas, these are large numbers. Start with a large number and, you do enormous amount of CAGR, and then of course you ended up with a very nice figure here. But just see the beauty of small returns. 10,000 monthly SIP, doing it for 30 years, for instance, 15% expected XIRR, you're adding or increasing your SIP annually by 5%, and you get to 8 crores, 19 lakhs at the end of 30 years. Simple numbers with long time, smaller returns but long time frame, and amazing amount of returns. Of course, this is also very good if you can do it, but getting a CAGR of 50% over 5-year period is extremely difficult. Extremely difficult, but yes, some people will do it definitely. So the power of small numbers, small steps, as James Clear would say in his Atomic Habits, keep doing some small effort every day, every week, every month, and you will keep getting better and better and better and better, and that compounds over time. So let's see the Nifty returns. This is the Nifty 1-year returns in the last 20 years, 2 decades of Nifty returns, 1-year returns. 1-year returns are basically going from previous year to this year, then going from this year to next year. So 1 year at one point of time. And you can see that these are all over the place. There have been years where you had minus 20% return. There have been years where you had plus 70% return. The next year was 15% return. The next few years later, it was minus 50% return. Another year was plus 70% return. So these returns are all over the place. And usually, when the markets are down, nobody will be buying stocks, nobody will be investing. Only after looking at this kind of a return in 1 year will people come and flock here. People will come and flock here only to see, the kind of drawdowns, etc. So, returns are not so important, I would say. I mean, if you see rolling 10-year CAGR, Nifty has been, earlier part of the decade around 15%, then it went down to about single digits and now near again 10 to 15%. So over a period of time, you can see that the rolling 10-year CAGR has not really had the volatility of single year returns, and had you constantly kept coming in even during this drawdown, you would still be in a good place in terms of chasing moderate returns. So to sum it up, I mean, investors ignore the fact that replicating similar returns every year is impossible. So every time you see a year where Nifty is 50% up, don't have your expectations that it can keep happening every year like we've had in last 2 years. Next 2 years may or may not be similar. So you have your expectations a bit moderated. High returns always come with high volatility. So you've had fantastic years, 60, 70, 100% year. Next year maybe minus 40% year. So you have to gradually bring in your capital and give it more time. Compounding at 15% XIRR CAGR is the most underrated thing today. I see that in our bouquet of strategies also, the strategies which are slower, for instance, LTC NX 200, EverGreen, then MI20, MI35. Of course, they are better than 15%, but I am myself targeting that if I get 15% or nearabouts or better, I think we've done well. So that is our sort of benchmark, that 15% is where we would want to achieve in a longer time frame. And by God's grace, in the last 5 years, we've done much, much better than that. But 15% is also very good. That's what the point that I'm trying to make. You can also see this video, episode 145, that we have of getting to your first crore, and see how even with moderate returns you can get there. Everybody can get there provided they give substantial runway to their investing. Spending more time with simplest strategies can reward you in ways you cannot imagine. So whether it is investing, whether it is trading, whether you're doing option selling, option buying, whatever it may be, if you have a strategy that can give you positive expectancy, and if you can repeat it over and over again with proper position sizing and ensuring that you don't lose all your capital, you can still make very, very good returns. And the most important part is that don't jump strategies. Markets and economy both work in cycles. It will go up and it will go down, but your strategy needs to sail through that. So when the economic cycle is going down and then it will come up in a recovery, peak out, going down, this will keep happening from decade to decade. So you cannot come in here, get out here, then come in here. That is not investing, and that is not really playing the market the way it should be. I mean, if you are able to bring in your money gradually over a period of time and investing in strategies that have positive expectancy, definitely you will do very well, even with reasonable returns on your strategy. So this is all I had for today's Daily Bite. I hope you're liking this content, and I'll see you in another one. Thanks. Bye.